Hello, everybody, and welcome to Masters of Real Estate. My name is Mathew Owens, and I'm a California licensed CPA and full-time real estate investor. And today I'm going to talk to you all about how to make money by adding value to operators and helping raise capital in different ways on syndication investments, on real estate investments, and any type of investment out there. There are strategies to be able to raise capital and make money raising capital. There's a million ways to make money in real estate, right? You can find deals, you can analyze them, you can do the operations, you can actually do property management, you can do consulting. There's all different ways of making money by being involved in different real estate transactions. One of those ways is by helping to raise the capital for a deal. And there's an entire industry out there all geared towards raising capital for real estate. However, there are some big be carefuls out there when it comes to the capital raise side of adding value to a deal. If you are not a licensed broker, you may have some issues with being able to be compensated for raising capital specifically. And it's a big no-no, and you got to be careful because there's a lot of SEC rules and guidelines around this space. So if you are out there trying to raise capital and you are not a licensed broker and you're getting paid for specifically raising capital and getting paid for the exact amount of capital that you're bringing to the table, then you are breaking some rules. And a lot of investors and capital raisers out there break a lot of rules all the time. Now, it probably won't be the biggest deal in the world until something goes bad, until the deal goes bad and someone finds out that you got compensated, or the SEC finds out that you got compensated incorrectly and unlicensed to actually make money in that way. And the reason is you are technically selling a security. If you're raising capital for a syndication deal where you pool investors' capital together into one pooled investment, and you're out there raising capital from your investors or from outside investors and bringing them to the table, and you are getting compensated based on how much you bring, you have to be a licensed broker because you're technically selling those securities. So big thing to be careful of, right? So the structure of this and how you get paid is really important. If you are an active general partner on a deal and you are involved in that deal, you're doing operations work, maybe you're finding the deal, you're going out doing financial modeling for that deal, you're helping in a bunch of different ways from an operations standpoint, then that's amazing. You can technically get compensated out of that deal. But even then, your compensation cannot be tied to exactly how much capital you are raising on that deal. You're still selling the securities and you'd be unlicensed to do so, even if you're a general partner of that deal in particular. You are getting paid as a general partner for your outside services that you're bringing into the table, for the workload that you're putting in, not for specifically bringing capital in on that particular deal. So, how do you get around this? How are some of the strategies to do this right, to make sure that the legal aspect is taken care of? And you have to be able to understand some of the underlying intricacies of capital raising in the first place. So many times there's different regulations that are out there that enable you to have an exemption from raising capital for securities, right? Normally you have to have a licensed broker dealer license, but there's exemptions out there, usually what's called a Reg D filing that allows you to raise capital as an exemption from securities laws. And so in these cases, you have to file with the different states that you're raising capital from and do the what's called blue sky filings for when you're raising capital. So in this case, there are a couple of different options that you can choose. One is called a 506B, a Regulation D 506B investment strategy, where you are allowed to raise capital from accredited and non-accredited investors. So an accredited investor right now, as the definition sits, is someone that makes over $200,000 a year every year for the last couple of years if you're single, or $300,000 if you're married. or has $1 million in net worth, excluding your primary residence, that qualifies you as an accredited investor. And so, in that case, in a 506B filing, you are allowed to take up to 35 non accredited investors and unlimited accredited investors that have that designation of a high net worth investor. And it's because the SEC thinks, hey, they're protecting the little guy. In my opinion, they're stopping the little guy from being able to invest in these amazing strategies that really compound your wealth out there. And so 506B is one regulation, one exemption that you can have from securities, selling securities for your particular deal. So that's one strategy you can utilize. However, you are limited on the number of non accredited investors, and you can only go out to pre-existing relationships that you already have in your database. You can't go out to outside people you don't know. You can't go out and advertise out there to random people on social media and things like that to raise capital for your project, right? So can be very limited based on your own database and your own relationships out there currently versus being able to advertise. There's also a exemption called Regulation D 506C, in which case you can actually go out and raise capital from unlimited investors, but they all have to be accredited investors. You can't have any non-accredited investors in your fund. So you are limited by the number of people because there's less accredited investors. However, you can get out there and advertise. You can bring in outside money for relationships that you don't necessarily have right then and there. You still have to make sure they're qualified, they understand what they're doing, and usually there's an outside source that's verifying that they are truly accredited investors in this situation. With each one of these different exemptions, and there's more out there, but this is not a very, very long talk, so I'm not going to go into all of the different exemptions out there, but these are the very common ones that I see out there consistently. And in each one of these structures, there are general partners and limited partners. And those limited partners are usually passive investors that want to invest passively. They're not obligated and on the hook for loans on the investment. They're not having to do all the work on the investment. They are truly passive investors. And so there's an opportunity out there for you as a passive investor to create your own entity to invest in that opportunity that you see. And then by doing so, raising capital inside of your entity to then go invest in these other securities. By doing so, that's called a fund of funds structure. You are raising money to be able to go invest into these other opportunities. And usually, if you're bringing to the table $500,000 or more in many of the syndication investments, the 506Bs and the 506Cs that you see out there, there's structures and strategies to help larger investors make more money. So, for example, you might have a 60-40 split with the general partner as a limited partner investor. But if you invest over $500,000, for example, you might be able to get a 75-25 split, so a little bit better of a split. You might get some discounts in fee structures and things like that to be able to make it so that that $500,000 investor makes a little bit more money. And so what happens is you can create this fund of funds structure and be able to raise capital inside your entity to become above $500,000 of total investments. And each fund is a little different. Some people make that limit $1 million or $5 million, depends on each individual deal. But you can come in and raise that money and get better splits for your LP limited partner investment vehicle. And then you can share that with your private investors in your fund, and they can make a little bit more money. You can make money by doing it as well as part of the better splits that you get by pooling a larger capital source together to then invest in this syndication. Now, you still have to do SEC filings with that type of entity because anytime you are pooling investor capital together, you have to file with the SEC because you have to have an exemption yourself from selling securities. And so in a fund of funds structure, you can actually go out and raise capital, make money by raising that capital and doing other services for your fund and doing administrative work and communication work and all different types of services that you are providing to your fund or even providing to the general partners involved in that particular deal and adding value in multiple ways. So there are structures and strategies, just like I mentioned in the fund to fund structure, to be able to make money and not be a licensed broker dealer, but you have to have the right structure in place and the right strategy in place. And it's different in each state. So you have to get a syndication attorney in each state. And don't take anything that I'm saying right now is gold standard legal advice. It's not. You have to get the right advice from the right attorney that researches the laws in the states that you're raising from and in the state that you currently reside as well. So all of these things are really key, but you can make a ton of money by having your own resources, pooling them together, and helping another operator to bring more capital to the table for them. It's a really exciting way to add value in real estate on top of the million other things that you can do out there, from operations management and property management and bringing deals to the table and all different types of things. So don't limit yourself by your own capital when you're trying to invest in real estate. Don't limit yourself by your resources that you can bring to the table with regard to operations work and everything else. There's other ways of making money, just like raising capital out there, that you can actually do to be successful and gain your net worth and utilize other people's capital to make money off of their capital and make sure that those investors are protected. Remember, the number one thing that you want to be careful of whenever you're raising capital for real estate is to make sure your investors are protected at all costs. That means you need to be educated on the right due diligence strategies to be able to invest your money or other people's capital into these types of deals. So go out there, learn the due diligence that you need to do on the operator, on the deal, on the market, on all the different aspects of that particular deal or any particular deal you're looking at raising for, because you have no right to raise the money and from other people and help them invest their capital in these projects without knowing how to do the right homework to make sure everyone's protected and that you're working with the right operator in these different ways. So you have to be able to go out and do that due diligence correctly. Otherwise, you're going to lose your investors' money. And remember, when you're working with investors' capital, it's not money you're investing. You are investing hours of their life. So I hope this helped add some value for you on the right structures and strategies in order to raise capital legally and effectively out there. Get that right attorney's advice in your market. And I hope this helped you guys add some value to you. If you want to learn more, you can go to MathewOwens.com, MathewOwens.com. Look forward to hearing from you. And if you want, you can go to my website and find my 200-point due diligence checklist to get you started on the right foot when you're investing in different syndications and doing the homework on deals. Look forward to talking with you soon and have a great rest of the day. Do you want to learn how to create financial freedom in your life through real estate and take your investing business to the next level? If so, you can follow us in one of the following ways. First, you can take one of our free webinars on how to analyze property, how to raise capital for real estate, and how to market and find deals. Three of the key pillars to becoming a successful real estate investor. Number two, you can join us on our mailing list where you'll get tips and tricks on real estate investing directly to your inbox. And number three, you can take our 6-month real estate course that teaches you every aspect of real estate investing you can think of, and more importantly, create financial freedom in your life through real estate investing strategies that I teach. If you want a master's in real estate in 6 months, this course is for you. We're going to go over how to raise money, promissory notes, syndications, fixing and flipping, buy and hold investing, tax and legal structures, self-directed retirement accounts, financial education, how to run a business, how to market and find your deals, and most importantly, how to create that financial freedom in your life so that you can stop trading your time for money and create passive real estate cash flow that you can live off of. If you're interested, go ahead and click on one of the links below, and I look forward to seeing you guys on the other side.